Good morning and welcome to this Monday, August 1st, 2022 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Well, we're starting off a new week, a new month. Hard to believe 7 months of 2022 is gone already. It's crazy. Heading into August, won't be long, we'll be talking about Thanksgiving and Christmas. Anyhow, market's in a much better mood, that's for sure. Today we got futures down a little bit, but it's Monday, right? Welcome to Monday. And I can tell you throughout the last 7 months, we've seen a lot of mornings that are down. It's the afternoons where we've seen a lot of rallies throughout the year, and especially over the last month and a half since the bottom went in mid-June. So, we're starting off this week a little bit slow, but that's okay. We've had a big run. The futures right now, I'm showing Dow futures down a little over 100, S&P futures down around 20, Nasdaq futures just under 50. But considering how far we've come up, I mean, we're talking about percentage moves of less than 0.5% across the board. So it really isn't much. Crude oil this morning down almost $3 back to 95 and change per barrel. That's been an interesting chart to watch because it's been squeezing on a daily chart. If you go back and look at the crude oil, which is $WTIC, pull it up on a daily chart, you'll see that it's been struggling to get through the 20-day moving average. The last 2 days, it's gone up to about $100 a barrel. Even I think on Friday went a little bit above, maybe to $102, $103 a barrel. But we reversed and came back down. We could not get a close above the 20. So we've been trending lower. And meanwhile, we've got recent price support down around $93 a barrel. So I'm kind of watching the $90 level. I think if we can stay above 90, crude oil is okay for now. But if we dip much below $90, I think that would be a sign that perhaps the energy run is over, at least for a period of time, and there'll be more consolidation and selling ahead, but we'll see. U.S. 10-year Treasury yield up a basis point today, 2.65%. It's a far cry from 3.48%, remember? That was 83 basis points ago. 83 basis points we've dropped in the bond market. I mean, if the bond market isn't saying inflation's dead, I don't know what is. I mean, we can talk about it and, say where it is on a 1 year basis and how high it's been, that versus last 40 years. You can say all the things you want, but I can just tell you what's going on in the charts right now. And bond traders could care less about inflation. You want a 10-year Treasury yield 2.66%, while inflation at the core CPI level is running at 6.5% or 6%. It makes no sense. You wouldn't do that. So why do folks keep buying bonds? Well, they're buying bonds because the inflation story is dead. All right, let's take a quick look. For those of you who are new to Earnings Beats, I always like to start off and let you know best way to get closer to us and understand what we're doing. Let's go over to the site, take a look. All right, so if you go over to earningsbeats.com, scroll down, you'll see our Earnings Beats Digest newsletter. It's free. All it takes is a name and email address. No credit card required. You can unsubscribe at any time. You're not going to hurt my feelings. Mondays, Wednesdays, and Fridays it comes out. We usually try to get it out around 8:30 in the morning, so you have it about an hour before the market opens. You can take a look at it, see what you think. I put in there this morning one of the tech stocks that I think had, I don't know, maybe not the best earnings report, but certainly a really good one last week. And when it did, it posted volume, the heaviest we've seen in over a year, the volume with earnings. So the one thing that's great about earnings, I love earnings season. It's giving us new information that the market did not previously have. Now, I mean, I could argue, well, Wall Street's got it because Wall Street's going out meeting with these companies and so forth, but they haven't announced it. It's not public information at this point until the earnings come out. And then, you see a lot of big gap ups, gap downs, because Wall Street's trying to figure out, okay, where do we reprice this thing given market conditions and giving the growth of the company and given their prospects, their guidance, what's the right price? And of course, everybody disagrees on what the right price is, which is why we have volatility and market prices go all over the place. But if you take a look at how some of these companies trade after earnings and look at the gaps, obviously, if a stock is gapping up, then the reaction is positive. If it's gapping down, reaction is negative. That's pretty easy. But I like to follow what happens after the gap. The gap, many times a gap up or gap down, you'll get a gap fill, which just means you go down to the prior day's close. So let's say yesterday you're trading at 20, you have great news, you open at 23. Sometimes, many times, stocks will go down and test 20 again. That's a gap fill. You gapped up and now you're filling back the gap all the way to where it was before the gap. That's kind of a normal thing. But when stocks gap up and they keep going, you have to think about how the market works. When everybody wants to buy at the open, so let's say, that stock is at 20 and gaps up to 23. Everybody wants to get in. Who's selling? Market makers. They provide liquidity to the market. That's what they do. When everybody is on one side of the trade, market makers are on the other side. They provide liquidity. That's one of their primary responsibilities. They're providing capital to allow our markets to flow efficiently. So when you want to buy at $23 that morning, if there's nobody to sell, well, guess what? Now you have to bid 24, 25, 26, 30, 35 until somebody's willing to sell you. With a market maker system, basically the opening price, market makers are willing to take the other side of that trade. So you want to buy at 23, they sell at 23. I can tell you one thing about the stock market. Market makers don't lose money. So if you want to know why most gaps fill, it's because market makers are on the other side of the trade and it behooves them to use their capital to drive prices lower. So one thing that's really bullish about a company that comes out with earnings is when they gap up, market makers are on the short side and that stock keeps going up. So you get these big hollow candles on massive volume, because what that tells me is that the demand was so great that the shorts, the market makers who were shorting the stock, had to cover. They had to take losses, which they don't do very often. That's telling you that demand is very, very strong on the stock. So when it comes back to that where it opened, like on that $20 example, it opens at 23. Let's say it runs to 27 before it finally slows down. When it starts coming back down, I then look for 23 as support, not 20. I don't look for that gap to fill. A lot of times when it gets back down to that 23 level, buyers jump right back in. So those are some of the things I look for during earnings season. Anyway, I know I spent a little time talking about that, and I don't have any charts up for you. But here is that area where you can sign up. Make sure you sign up if you haven't already. We do a lot of free events, by the way, and we reach out to that community. So if you're on our Earnings Beats Digest and we have a free event, you'll get an invitation to go into the room and watch whatever presentation we have. We try to make it as educational as possible. All right, taking a look at the action from Friday, Dow Jones Industrial Average finished up about 1%, 315 points. S&P 500 up nearly 1.5%, 58 points. The Nasdaq, and by the way, S&P 500 now up over 4,100. When it broke back up here above this high, I thought it was making a run for 4,175 to about 4,200. Well, we're almost there, 4,130. This would be a very interesting level because you can see there was a lot of support previously just below 4,200. Then there was this resistance level just below 4,200. I think we could go just a little bit above that. I think that would be an indication that we are uptrending, a rising or upsloping neckline, potentially neckline, because I could see a bottoming head and shoulder, which I've talked about. Left shoulder, neckline, head, right side of the neckline, upsloping would be better. And then a pullback, if we go back down to 3,900, 4,000, we could put in a right shoulder. And then that move through 4,200 would be a confirming bottoming reverse head and shoulder pattern breakout. So that's something to look at. Doesn't mean we have to have a head and shoulder bottom. It's just one pattern that we could see develop. We might go right through this level. Just defy all odds. Just keep going straight up. I mean, we could have a V bottom. That's one possibility. Anyhow, Nasdaq up nearly 2% on Friday, up 228 points. By the way, breaking above that prior high. that reaction high back at the beginning of June, we've closed above it. So the Nasdaq, which is the more aggressive index, is already showing a breakout. Bullish. That is bullish. I don't know how anyone can argue that being bearish. S&P hasn't broken out. Nasdaq has. Nasdaq's the more aggressive index. Mid caps continuing to strengthen. This is a really strong rally here. Mid caps up 32 points, or about 1.25% on Friday. Small caps up 10 points, which was up a little more than 0.8%. Look at the AD lines on all of them. Unbelievable. And AD lines are so important. They're great secondary indicators. I've said this recently, and I think this is important. They're not great primary indicators. And honestly, I'm finding that out with our strong AD portfolio. Had a good week last week, but overall, really over the last year has not performed well. And that is the primary thing we use to select stocks in the strong AD portfolio, is the AD line, strong AD lines. So I'm learning always in the market. When you stop learning, you ought to just go golfing all the time and put your money under your mattress or something. Always be ready to learn in this market, because otherwise it'll just eat your lunch. But the strong AD line, I think it's a great corroborating indicator of a chart that you really like for whatever reason. If it has a strong AD line, I would like it more. If it has a weak AD line, it would kind of take away a little bit of the confidence I have in that particular stock. But anyway, AD line's absolutely soaring on the major indices right now, breaking out to all-time highs. That tells me that there is a lot of buying behind this rally. And it's hard again for me to be bearish looking at what I'm looking at right now. I mean, even if you were in the bearish camp, if you're not getting into the bullish camp, I think it's because you're stubborn and you just don't want to admit that the bottom is in. I mean, is it a guarantee that the bottom is in? Of course not. Market can do anything it wants at any time. I don't know. Market could go right back down. We could go to new lows. But just about every indicator, I've done a lot of studying in the stock market, a lot. I would argue that I've done more than just about anybody. I have a real passion for this. I do it a lot in my spare time. I do it throughout the day. I do it for our members. I do it for myself, my own trading. I spend a lot of time researching the history of the stock market. And I'm telling you, rarely do you see this kind of behavior where we go back to a new low. Not going to say it doesn't happen. In fact, in secular bear markets, you can get head fakes like this. The only thing I would say is that if we don't lose that 20-day moving average, and if the S&P 500 does not lose 3,900, I can't be bearish, cannot be bearish at all. Energy up 4.33% on Friday, leading the sectors. Discretionary stocks, another big day, up nearly 4% thanks to Amazon. Tesla's having a huge run. Those are the two biggest weightings in the XLY. They are on fire right now, and as a result, discretionary breaks out. Looks like a bottoming formation there that's now been confirmed. Industrials up more than 2% on Friday. Technology up 1.5%. Technology already making a pretty big run. And look at those AD lines. I mean, technology now setting a new high above the April high. Discretionary still got a little bit of work to do, but it's trending in the right direction. Industrials breaking out to new highs. Staples, the worst group on Friday, down about 0.75%. Look at that AD line breaking out. Everything, for the most part, is going higher. This just reeks of the resumption of the secular bull market. Ten-year Treasury yield. Let's get an update here. So right now, 2.649. It's come down off the earlier high. Still up a little bit, less than 1 basis point, sitting at 2.65%. But overall, this, I believe, is going lower. We've now closed below 272 consecutive days. I believe we are now, instead of looking at this as sideways consolidation with support at 270 and resistance at 348, I believe we're now downtrending. And the falling 20-day EMA is what I would follow to the upside, which right now is at 286. And to the downside, I think we could go all the way back down to this low right in here. I believe eventually I don't know, maybe it's the end of the year, maybe it's before that. I think we're going back down close to 2%. I think you're going to see mortgage rates drop. I think you're going to see the Fed much more dovish, much more dovish. They already laid the groundwork last week. They said, hey, you know, we're concerned about inflation. We're going to keep fighting inflation. We're going to do this. We're going to do this. No, by the way, it's data dependent. They threw that in there, data dependent. That's just giving them an out. I mean, I said back at the beginning of the year, there's no way they were going to raise rates 12 times. They said they were going to raise rates 9 times this year and 3 times next year. I said that was, you know what that was. That's what I was thinking. I want to say it, but I won't. They weren't going to raise that many times. The Fed uses their podium to essentially sway the markets. They use their power. Yeah, they'll raise rates, but then they also will talk tough. Sometimes all they have to do is talk tough to get their way. They weren't getting their way. They were talking tough for a while and it wasn't working. So they were like, okay, we better start raising rates. You know, I've had a lot of good calls over the last couple of years, but one of them that wasn't so good was the fact I didn't think the Fed would be raising at all, maybe once or something. I thought that inflation would be quickly in check. It wasn't. Those were not good calls. But I do think, based on what I'm seeing right now in the bond market and with what the Fed said, I think yields are coming back down. And that is going to be wonderful news for stocks, because the inflation fears were stoking the interest rate fears. And then that was stoking the recession fears. And a lot of folks looking at all the bad news saying, how can the market go up? We got all this bad news. How can the market go up? It was priced in. The S&P 500 lost 25%. Since 1950, that's only happened 8 times. The stock market looks ahead. The stock market priced in everything you're seeing in the market right now. All the news you're seeing, priced in. Stock market now is beginning to price in what it sees at the end of the year or into the first quarter of next year. Could care less about inflation. Could care less about this possible recession that we're in. I think we're already in it. 2 consecutive quarters of negative GDP. That used to be the old definition. Now they've changed the definition so that they can kind of decide whether it's a recession or not. Maybe they can talk about it a little bit longer. You know, it's like saying the bear market threshold's 20%. And then somebody's saying, well, let's just see how everything goes. And then I'll let you know whether it's a bear market. I mean, I could care less about the 20% threshold. 15%, 25%, it's all bad. Market comes down that far. So I don't worry about the technical definitions. I worry about whether the stock market's going to go up or down. I'm worried about whether I'm going to lose money if I stay in the market. That's what I worry about. I don't care about you call it whatever you want. You want to call this a recession, call it a recession. You want to just call it a slowdown and we're not sure, fine. Call it whatever you want. Stock market sold off. Stock market saw it coming. Anyway, 10-year treasury yield, I think, goes lower from here. So let's take a look at the S&P 500. I've been pointing out to members, I've written about it over at Stock Charts. This behavior right here reeks of a bull market advance. Rarely do you see in a bear market a move through the 50-day moving average coming off a bottom, a move lower to test moving averages, price support, whatever, and then make another move higher. Rarely does this happen. 3 times since 1950 this has happened, before this time, where we didn't keep going higher, where we actually went to a new low. 3 times in 72 years. So if you're in the bearish camp, those are the odds that you have. 3 times out of 72 years. 1973 or 4, 2001, and 2008. All 3 secular bear markets. Those were the only 3 times we saw periods of prices moving higher where we were able to get through the 50, pull back, set a low, and then break out again. In every cyclical bear market, this has ended it. 0 exceptions. Not 1, not 2, 0. Of all the cyclical bear markets, not one time have we ever had this configuration and gone back to a new low. So you got to decide, just like I decide all the time, you got to decide about your risk reward. We've gone down 25%, 8 times, 9 times, whatever it is. 3 of them have been secular bear markets. Excuse me, 8 times have been cyclical bear markets, 3 secular. So actually 11 times we've gone down 25%. 3 of them have turned out to be secular bear markets where we've gone down 50% or more. The other 8 have been cyclical bear markets where this type of bottom right here has marked the bottom every time in those. So you've got to decide what you believe. I've seen Wall Street moving into aggressive areas of the market. Growth over value. I've seen, the QQQ versus the S&P 500. I pointed that out earlier. Nasdaq breaking out, the S&P's not. Why is Wall Street moving into aggressive areas if we're going to another low? The XLY, XLP, might as well show you that one. I'm always, looking for breakouts there. Look what happened on Friday. Double top breakout. This is a sustainability ratio that has probably the highest positive correlation with the S&P 500 of all of the ratios I follow. This one has the highest correlation with the S&P 500. It just broke out. S&P hasn't broken out, but this ratio did. That tells me the S&P is coming along for the ride. How about sentiment? I said beginning of the year, we needed sentiment to reset. We had sentiment, which was crazy bullish. We needed to get the 5-day moving average of the equity only put call ratio to a minimum of 0.75, something that it never even came close to for the last 2 years. I'm going to pull up this chart on the CPCE. This is the equity only put call ratio. If you go in here and you put in a invisible chart and then come down, actually, I don't need the AD line. Do a 5-day simple moving average. So I don't need all the daily data. That's why I put in invisible. I have one overlay. It's a 5-day moving average. So when this comes up, it's just going to be showing us the 5-day moving average of the equity only put call ratio. I'll get rid of everything else. Actually, let's come down here. Let's put in the price of the S&P 500. So, and if we go back 10 years, here's the 5-day moving average. Here's where we were coming into 2022. The 5-day moving average for a year and a half while the market was going up. Look at all, this means that a lot of calls were being traded, very few puts on a relative basis. Think Reddit, think the Wall Street bets, folks. Think all the meme stocks. Just think about those people coming in, all those new traders who just knew all you had to do is just keep buying calls and the market would keep going up and you just make lots of money. And I said there was a day of reckoning coming. That was one of the things I talked about back at Market Vision 2022. This had to change. Look back at history. We've never seen so much bullish action in the market, in the options world. Everyone thought it was an ATM machine. I can promise you from years of experience in the stock market and having plenty of losses over the years, I paid lots of tuition learning about the stock market. This doesn't fly forever. We needed this, and that's what I said at the time. I didn't want to wish any ill will on the stock market, but we needed that. We needed that to get rid of all of the complacency and all the bullishness. And everybody just feeling, everybody that could buy was already in. There was nowhere left for the market to go. We had the biggest 22-year rise in the S&P 22-month rise in the S&P 500 since I began tracking it back in 1950. We'd never seen anything like this. Never. Not once. Not in the 1980s. Think about that big run at the end of the 1990s. Not then. We'd never seen this kind of a run over a 22-month period. We needed this. We needed folks to get fearful. We needed people to think market can't go higher. And now everywhere you go, people believe market can't go higher. I did my bottoming call on YouTube. I don't know if you all saw those comments. I got a kick out of reading because I don't care. I put it out there. If folks want to listen, they listen. If they don't, they don't. I don't care. Well, I do care because I want them to learn. But if you choose to ignore some of the things I've learned from history and going back and studying the stock market, that's your choice. I throw it out there, things that I've learned. I got a lot of my inspiration from John Murphy. He threw out things that he had learned over the years. I picked it up and ran with it. And that's really what I'm doing. I'm trying to give back. I'm not right all the time. I can promise you that. But I do think I improved my odds. And that's what this is all about. Anyway, look at where we got to on the 5-day moving average of the equity only put call ratio. We got to 0.68. And look at the market rebounding here. And look at the 5-day moving average climbing. Awesome. I couldn't ask for anything more. Sentiment job is complete. I said we needed to get to the point where sentiment was reset, where nobody believed. Now we're going up, and look at the options world. Everybody pouring back into puts again. I mean, I hate to say it, but most options traders, there are some really good ones that do this for a living. They're astute. They manage their risk. They do it when it's appropriate. There are a lot of folks that are in options that are just throwing money onto the roulette wheel. Lots of folks. I would say the majority of options traded are folks that are just hearing something, seeing something go up, or thinking about how much money they can make if it keeps going in that direction, and then they pile in. They got a lesson about a bear market top or a bull market top back into 2021. And now they're going to get a lesson of a bear market bottom and how they form. All right, another group that is looking good, or one group that I think is starting to look good, footwear. So I've been watching it go down, down, down. Finally, though, we are now starting to trend up. Volume has been coming in these last few days. I'm going to give you 3 footwear stocks to close out the show in just a few minutes. We wrap up with the 3 you must see. But this looks pretty good. I mean, look at that. That's the best the PPO has looked since back at the end, fourth quarter of 2021. So we got the bullish momentum going. We've now got a bullish configuration, and it's just kind of following along. It's just like this bull market, taking one group after another. All right, blog highlights. I don't know if you saw my articles over the weekend, but if you didn't, I wrote a couple yesterday, talked about heading to new highs, talked about, where I saw the market going at the beginning of the year, and pretty much followed right along. I talked earlier in the show here about bear markets, cyclical bear markets. Here they are. This is all of them since 1950. If you go back into the article, you can read about some of those and how they tend to do very well. The market tends to do very well coming out of bottoms, which is why I'm trying to stay fully invested for the most part. Talked about the resumption of secular bull markets, went through all the prior cyclical bears and showed how we come out of those bear markets. And usually it's pretty fast to the upside. All right. And then the other chart I wrote over in Don't Ignore This Chart. The first one I just showed you, that was in my Trading Places blog. Trying to write a little bit more often and Don't Ignore This Chart. A few weeks ago, I wrote about Apple. Said Apple was a great buy down around 140, 141. What is it now? 162. So now that we are in this bull market, I think it's really important that you understand some of the key strategies to improve your trading performance. Talking specifically about earnings season, how you can, this was General Mills. Here was the earnings. Look at that, best volume, highest volume in the last year to accompany this huge move up with earnings. Kept going up, but look where it pulled back to. Prior highs, that's a support level, and there's your gap support level. 71 to 73 looks like great entry for General Mills. Bounced off 73 the first time, Looks like it's going higher. Maybe it just keeps going higher from there. But what we want to do is look at these stocks, establish where their key entry points are, and then just simply put them on a watch list and wait and wait and wait until we get our price. Some stocks we might not get our price. Some stocks we will. Some stocks will work out beautifully. Other stocks won't, and we'll keep our stops in play. That's the way it works. But you've got to be disciplined. So let's go ahead and jump into the three you must see, and then we'll wrap this thing up. First one is Nike. Nike, you can see three great candles there breaking out above this little neckline. I see a bottoming head and shoulder pattern, left shoulder, neckline, head, right side of the neckline, right shoulder, and a breakout. So I think Nike looks good. Volume starting to accelerate with this move. Deckers, another one I think that looks really good. Look at that AD line just taking off. Lots of resistance. Here was your support just below 300. Here was your resistance right up near 300. Look at the volume come in as you gap up above, close at 313. Change of character on this chart. This chart to me is much more bullish now. I mean, it started back in here, but I think this really has confirmed it. So anything back down to 20-day moving average makes a lot of sense on Deckers to me. Finally, Crocs have been waiting and waiting and waiting for this one. $180 stock went all the way down to 40s. Now it's moving, turning back up at 70. I don't know if it's going back to 180 or not, but if I'm right about interest rates coming down and the market going higher, I think Crocs goes higher with it. Now, it was $58 3 days ago. It's 71 now. So just arbitrarily buying here obviously presents a lot of short-term risk. So I'd put it on a list and wait for its next 20-day test. That might be next week at $60. It might be, this might go up to 90, and then the 20-day test may come at 70 on a pullback. I don't know where it's going to be. My point is, though, that Crocs is now much more bullish, and we should be looking at it from a bullish perspective in terms of trying to figure out our entry points. All right, that is it. Let's see what the market's doing as we open up a new trading week. Futures were down a little bit. Let's see. Yeah, we got a little bit of red today. We got the Dow Jones right now down 155. S&P 500 down 31, NASDAQ down 107. What I can tell you is that, number one, it's a Monday. This is not unusual if you follow the market. Monday blues, not unusual to see the market down on Monday morning. Not unusual to see the market down any morning, to be honest. I've gone back and studied the QQQ since the beginning of the year, and the stats, I mean, are unbelievable. I've shared it with Earnings Beats members. But let's just say mornings aren't so good. Afternoons would shock you. And I'm talking about all year. You know, the QQQ, if you traded it, if you bought it at 2 o'clock in the afternoon and sold it at 4 o'clock at the close, you would have made quite a bit of money this year through the entire bear market. The selling, especially as you got deeper and deeper into the bear market, a lot of the selling was at the open, the gaps, manipulation. And then, of course, when it opens lower, everybody panics. And so most of the selling was really by 10 a.m. in the morning. And then we started to see improvement throughout the day. That's why those AD lines are so strong. Anyhow, lots to learn about the stock market, I can tell you that. Anyhow, that's all I have for today. We do have a ton of earnings coming out this week. I want to say like 1,500 companies report this week. These are a lot of the second tier. Many of those software companies that have been struggling will be reporting this week. So, you know, if you own a software company other than, say, Microsoft or maybe Cadence Design, CDNS, which has done really well, many of the software companies will be reporting this week. And I noticed Thursday will be particularly heavy, Thursday afternoon. Anyway, I'll be back tomorrow over at Stock Charts TV for your next episode of Trading Places Live. Of course, that'll be a recorded version. Just go over there at 9 o'clock in the morning, click on Stock Charts TV, and you'll be able to join in on the show. Everybody have a great day. Happy trading.